Well, good afternoon and welcome to Sensible Financial Planning's webinar, Retirement Plan Fundamentals 3, Tracking and Opening Your Present. I'm Carrie Fristow and I'll be the moderator today. Today, Sensible Financial's founder, Rick Miller, will be speaking about how to use your retirement plan funds to retire comfortably. Rick holds a PhD in economics from the University of Chicago and started Sensible Financial 20 years ago. He is also a certified financial planner. You can register for upcoming webinars through a link in Sensible Financial's newsletter, which will be published later this month, or at www.sensiblefinancial.com/webinars. There will be a Q&A or two Q&As during this webinar, and just please submit your questions through the Q&A link at the bottom of your window. Rick will answer as many questions as he has time for, as I said twice, once approximately midway through the webinar and once at the end. He can't give personal advice because there just isn't time for him to gather the pertinent information, but he can answer a lot of general questions. We'll provide his contact information at the conclusion of the webinar, and we'll send you a link to the recording. Now, Rick will begin.
Thank you, Carrie, and welcome everyone. Last time, we talked a bit about how to use your retirement plan. Today, we'll discuss ongoing management of your retirement plans, and then, finally, ta-da, opening your present. Just to recap from a very, very little bit from the beginning, almost everyone retires, almost everyone works, that is, participates in the labor force, and you can see that participation in the labor force starts at a low level when people are younger, and then by the late 20s, early 30s, and certainly in the mid 30s and 40s, almost everybody is participating, 90% of men and 75% of women. And by the late 60s and early 70s, only 20% of women and 30% of men are still working. And by the late 70s and early 80s, almost everyone is retired. So now you will become future you, or alternatively, working you will become retired you. And when now you becomes future you will be older than now you, something like now you, but different in lots of ways, all the ways that we're showing here on the left, and too many others to specify. Now you may not know now when future you will retire, but still now you has some idea. And also now you have some idea about how much future you will spend. Less because some costs will disappear, like mortgages and the expenses of working, and maybe some purchase services now that you have more time, but still now you will have some idea about how much future you will spend. And importantly, future you's life is in now you's hands. We're going to continue to use our present and package metaphor. We hope not to the breaking point. And we're hoping not to push it to the breaking point. Now you faces important practical questions if future you is not going to be disappointed. Last time, we talked about now use questions of how you can save and what account to use. And that turns out to be, in terms of future use present, how best to fill the package and which package is best. That was in webinar 1. In webinar 2, we talked a bit about, or a lot about, how much to send, how much to save, and a little bit about what investments to use and what to put in the package. Today, we're going to finish that discussion, and also we'll talk about which accounts to tap, which package to open first, and how much to withdraw, how much present to use each year. So we're going to, again, continue with our discussion of how to invest contributions, and then we'll talk about should you change your investments. And I should say that this is, as I think Carrie did, this is the third of a series of 3 webinars. And if you find that you're getting a little lost here, it may be helpful to go back and watch the first 2. So if we think about investing in an overview, while it can seem very complicated and difficult, and making it mysterious, it can be seen to be to an advisor's advantage. In fact, a few simple ideas can lead to excellent investment decisions. And we've identified 4 areas of simple decision: setting your risk level carefully. We spent a lot of time talking about that last time. Diversifying, keeping your costs low, and fewer investments is better. And in general, the idea is that simple works, and choosing a complex portfolio is probably more expensive, probably because it's more expensive, probably lower returns, and it's harder to understand, and it's easier to worry. So simplicity has lots of benefits, lots of virtues. So we're saying simple, yes, complicated, no. And I'll emphasize, by the way, that, and this is on lots of slides, but this is not personal investment advice. The investments we discuss are not FDIC insured, and you can lose principal. I've said that once, I'm not going to say it again, but it's on each subsequent slide. Again, last time we talked about setting your risk level, the 3 kinds of investment assets: stocks, bonds, and GICs. We talked about stocks being riskier, but having a higher expected return, bonds being less risky, and GICs being quite bond-like. And I suggested that you should think about your risk capacity, future usability to cope with poor results, either by working longer or spending less, your risk tolerance, now usability to sit through market declines without changing the investment stance. And finally, I suggested that every 5 years or so, you should carefully reconsider your risk level. All right, so now moving on to diversification. And we're using the eggs in a basket metaphor here, but now these are jelly beans, not hen's eggs. And the idea here is that you could have one really big egg in your basket, and that the idea is that that's one security, or you could have many smaller eggs in your basket, and that's diversification, multiple securities. And why is that? Well, the fundamental, why is it that it's advantageous to diversify and have multiple eggs in your basket as opposed to just one? Starting with stocks, individual stocks are very risky. And one way to see that is to think back to, or you haven't probably read this research, but I have. A fellow now named Bessenbinder did research on stock returns, and he discovered that if he looked back about 100 years, that of all the stocks that were available over that 100 years, 4% of the stocks, that's 1 in 25, accounted for all of the stock market return in excess of Treasury bills. So that means that if you had managed to pick those 4%, you would have done very well. If you picked the other 96%, you would not have done so well. And it's really hard to pick if you've got a 4% chance or 1 in 25. The rest of the stock's average Treasury bill returns, that's not very much return for a lot of risk. So how can you be sure that you'll get at least some of the stocks in the 4% and not just stocks in the bottom 96%? And the way to be sure is to buy lots of stocks, lots and lots and lots of stocks. And we'll talk in a minute about how to do that in an easy way and how that can actually be very simple. Even though right now I think it sounds complicated because I'd say lots of stocks, right? Individual bonds are risky too, even if they're not as risky as stocks. So buying lots of bonds is also a good idea. And the way to buy lots of stocks and lots of bonds in a simple way is to buy a mutual fund. And in particular, if you buy an index mutual fund, then you're going to be sure to get all the stocks. And if you get all the stocks, then for sure you're going to get the 4% that have generated the excellent returns on average that stocks have generated. If you think about the index that you probably are most familiar with, it's the S&P 500 index. Buying a mutual fund that invests in the S&P 500 is a really good place to start. but there are indices that are broader and mutual funds that are also broader. But the S&P 500 has plenty of stocks. If you're comfortable with that, that could work as your stock investment. So we said diversify, buy lots of stocks, buy lots of bonds, and we've talked earlier, we talked last time, and again, I'll mention it this time, your asset allocation, the overall amount of risk that you have in your portfolio depends upon the proportion of stocks and the proportion of bonds in your portfolio. So if you said, well, I'm going to have all stocks, that's going to be much riskier than, let's say, half stocks and half bonds, or 25% stocks and 75% bonds. And we talked last time at length about how to choose the allocation that's best for you. Today, I'm talking about the components. So if we're thinking, if you chose an allocation of so much stock and so much bonds, the question we're addressing today is how to choose which stocks, how to choose which bonds. And we're suggesting that, I'm suggesting that for stocks, you could buy a diversified stock mutual fund, and an index fund is a very good example of that. And for bonds, you could buy a diversified bond mutual fund, and an index fund is also a very good example of that. Now, the point on this slide is keeping your costs low. And the growth of your present is going to equal the growth of the investments inside your package minus the expenses that are associated with whatever investments you have. You can choose investments in advance, but their performance is unpredictable. But when you choose a mutual fund, the expenses and costs are very predictable. So the net return that you're going to get is that unpredictable gross return minus the expenses. And if you have, let's say, lower expenses, the growth in your package is going to equal that investment growth minus the smaller expenses. If you have higher expenses, then the net growth that you're going to get is going to be less, because you're going to get the same investment growth, more or less, but here you have low expenses, here you have high expenses, and your package is going to be bigger. Present that now or the future you gets is going to be bigger if those expenses are lower. Now, some expenses can cover valuable services like advice and rebalancing, and you may want those services, and it may be worth it to pay for those services. But if the investments that you choose come with higher expenses and no extra services, you're getting a cost with no benefit. And it would probably be better to avoid situations like that, where you're buying a mutual fund, let's say, with higher expenses, no extra services. Fewer investments can be better investments. And unless investing is your favorite hobby, and maybe even if it is, simpler is better. Think about what you want from your investments and what you want to do with them. You want good returns. You want less angst, less anxiety, less worry. And you also might want to adjust your holdings over time, and we'll talk about that in just a minute. It's easier to understand the returns you're going to get if you have a simpler portfolio than if you have a more complicated portfolio. There's less to worry about, and it's easier to understand if it's a simple portfolio rather than a complicated portfolio. Well-diversified mutual funds will produce close to the market average returns if their expenses are low. That's hard to beat. And one way to understand that is to think, if you think about all the investors in the market, all the investors in the market together are going to get the market's return. By definition, they're going to get the market's return, less the expenses that they pay. So if you buy a well-diversified stock mutual fund, you're going to get the stock market's return, less the expenses of that fund, more or less. And on average over time, that's probably what you're going to get. Now, if you have in your portfolio few holdings, and by that I mean few mutual funds. So if you look at your statement, and you have a stock mutual fund and a bond mutual fund, you're going to have two holdings. Even though inside those mutual funds, there could be thousands of stocks, thousands of bonds. So you could be really well diversified. But when you look at your statement, it's going to be really simple. And you can look at it and say, stocks, risky. Bonds, safer. That's my portfolio. And if you have a well-diversified mutual fund for each choice, you hold almost every stock that's important, almost every bond that's important. It's that can work very well as an investment strategy. If you have few holdings, then it's easy to understand what happened. If stocks went up, your stocks went up. If stocks went down, your stocks went down. If you're holding two funds, then you're going to have one or two funds up, one or two funds down. If you've got 3 funds or 8 funds, you're going to have 3 funds up and 5 funds down. Well, what happened? And figuring that out, it can be figured out, but it's a lot of work, and it can take a lot of time or a lot of training to understand what's going on, and that may be time and effort that you'd rather spend elsewhere. And it's not necessary to do all of that kind of work to have a well-diversified portfolio that gives you access to the upside that stocks offer and access to the relative stability that bonds offer. It's easy to buy funds that have thousands of stocks or bonds that cost less than 0.1% of the assets each year. That's very diversified and very inexpensive, very efficient. And you can have a simple portfolio, simple in the sense of few holdings, that actually spans the whole market. I used to say, this is not your father's investing or your mother's investing or your grandparents' investing. We live in a time where one can have a very well-diversified portfolio very inexpensively. There's a sense in which it's a golden age for investors from that perspective. Okay, so now, if you're thinking about your employer plan, how can you do that? How can you get fewer investments? And you can look at the choices. If there are lots of choices, you can look for broad index funds, and I've suggested a couple here. You could buy an S&P 500 fund for US stocks, or Russell 3000 fund for US stocks. If you want international stocks, you can look for MSCI All Country World Index. And for bonds, you can look for the Bloomberg US Aggregate. Those are very well diversified funds, and you could build a portfolio with just this and just this for stocks and this for bonds, or both of these for stocks and this for bonds. That's going to be a perfectly fine portfolio. But if you're still concerned, you're still confused, talk to HR. They can help you, or either HR or somebody in HR can refer you to somebody who can help you sort of see through the list, which can otherwise seem very overwhelming, and help you choose a simple portfolio. The risk is that you'll look at often employer plans have very long lists of investments, and you could look at the list and say, well, it's just overwhelming. I don't know what to do. I'm going to put it in the money market fund. Probably not the best choice. Or you might say, well, I'll just pick, one from each category. And that produces what I call the illusion of diversification, because often if you pick multiple stock funds, if you looked inside them, lots of stocks in each fund, you'd find many of the same stocks in both funds. So a few index funds is simpler, easier to follow, and will give you just as much diversification. If you make the right fund choice, then you only have to do it once. And it's worth the embarrassment, the potential embarrassment, to ask for help. And by the way, most people need help with this decision. Most people are not investment experts. So it's not it's wise to seek advice. It's not an indication of weakness or something of that sort, and it shouldn't be embarrassing. Okay, so when you're investing in your employer retirement plan, they'll ask you to choose usually it's online, and it will ask you to choose how to invest your contributions and how to invest your investments. And what that means is when you put money in, how will the plan invest the money? And then if there's already money in the plan, how should that be invested? And the simplest approach is to invest the investments, the existing portfolio and the contributions in the same proportions, and match those proportions to your asset allocation. And I've shown one here with stocks, bonds, and GICs, and you've got the same allocation for the contributions and for the investments. Again, I'm not recommending this particular allocation for you. Your allocation is specific and personal to you, and you should figure it out yourself, potentially with some advice, but this is not advice that's personal to you. Now, many employer plans also offer what are called QDIAs, or Qualified Default Investment Alternatives. Those are the investment choices that the plan will make if you decide not to make a choice. And we've used here the analogy of a prepackaged box of chocolates versus a box of chocolates that you fill yourself. And this can be a good approach. Often these QDIAs are called target date or life cycle funds. You can choose the one that is, they're often dated in 5-year intervals. So you can choose the one that has the date that's closest to your retirement date. They're intended for people who want someone else to make the investment decision for them. And these can be very useful, and they can be a good choice. It's important to recognize that target date funds for one target year from different managers may have different investments. So if you look at Vanguard's 2060 and Fidelity's 2060 and T. Rowe Price's 2060, they're not going to be they may not be the same. So it's important to look inside to be sure that it matches the allocation that you've chosen for yourself. And then that can be kind of a set and forget approach, which many people find helpful and useful. The caveat is that, you know, the advantage can also be a disadvantage. You're relying on professionals to make your investments for you, but they're making them for the average person that's retiring in 2060. You may not be average. And so it may not, and 2060 being an example, right? The target date fund dated 2060 is designed for the average, if you will, of people who are going to retire in 2060. And if you're retiring in 2060, you may not be average. And so you may want to do something other than the target date fund if that's the case. Now, in your IRA, you have a lot more choices, and if the IRA is at a brokerage firm, it may seem that there are infinite choices. It's even more important in that setting to be sure that you keep your portfolio simple. If you ask for help, a little bit more caution is going to be required. If you're doing this at an employer plan, the choices were selected, the investment choices were selected by the plan's trustee. There are likely to be fewer choices, and whoever is advising you is probably not incentivized to choose based on the payments that they would receive from one or the other mutual funds. They're not going to be receiving those payments. At the IRA, the choices aren't curated by anyone. It's basically the whole universe of investments. And if you get an advisor, they may be incentivized toward funds that are more profitable to the custodian. So that just to watch out for that. You can insist on an index, and again, keep it simple. Match the account allocation to your overall allocation target. So here I've shown your overall allocation target and allocating in the same way your IRA. And this is just a sort of a by the way point. IRAs often don't offer guaranteed investment contracts. Okay, now once you've made these choices, time will proceed and you'll get investment returns. And because the stock and bond markets behave differently, and we're looking here at, this is the stock market in the S&P 500, and this is the bond market, the Bloomberg US Aggregate, over from 1995 to 2023. So, 30 years or so. And you notice that if you looked at your report, if you had invested in both of these in 1995, at certain points, you would have had a lot more stock than you started with, or a lot less stock than you started with. And so the question is, what do you do about that? And the first point I would make is, don't react to daily or weekly or monthly fluctuations. I would recommend that you choose an annual time to rebalance. Pick what I call an easy time of the year, when there's not much competition for your attention. So don't pick tax time, or just before Christmas, or at the height of the school year when if you've got kids. Pick a time when you can take it easy and you have time to think about what you're doing. And then at your rebalancing time, you can trade back to your target allocation, whatever that was. So if your target allocation is 50% stocks and 50% bonds, and you look at it, and now it's 40% stocks and 60% bonds, you might sell bonds and buy stocks to take it back to 50-50. Now, if that is the case, if stocks are low and as a percentage and bonds are high, that could feel really uncomfortable, because it's likely that we've just had a stock market decline, a significant stock market decline, and you may feel very uneasy. And if you're very uneasy, don't trade. Wait till next year. I wouldn't say, wait until stocks have recovered. I would say wait until your next year rebalancing time and see how things are, if you don't want to trade, if you don't feel comfortable trading. If stocks are up, and so now if you're 50-50 portfolio, stocks are now 60%, bonds are 40%, that's at your rebalancing time, probably a good idea to sell some stocks, buy some bonds, so that you're back to your target. You may feel like you're giving up on a good thing, because it's likely that times will be good, right? That everyone will be optimistic, and that's a really good time to take your gains and salt them away in a safer asset. All right, now the markets, especially the stock market, can move a lot. And if you've chosen your target allocation well, you can afford the risk that you've chosen. I advise against checking your portfolio often. If you look every day, you're going to be unhappy a lot, because the stock market goes up and down, and it goes down almost as much as it goes up. So if you look at your portfolio every day, 45% of the time, you're going to be unhappy, because the market will be down. If you look every month, you'll be unhappy less often. And if you check every year, that's probably about right. If you check and you feel you should do something, I would say, so sometimes the market moves a lot, maybe it's up, maybe it's down, you'll feel you should do something, but what should you do? I say, don't do anything. My favorite quote is, don't just do something, stand there, because you don't know where the market's going from here. No one knows where the market's going from here. You're investing for a lifetime, your lifetime, now use and future use. Keep your eye on the horizon, not on where we are right now. Make your adjustments on your annual rebalancing day. If you're going to rebalance, do it then. Otherwise, don't. Okay, Carrie, we can pause for questions here.
Okay. The first one we have is someone asked, what is a GIC? What is that stand
What
for?
is a GIC? A GIC is a guaranteed investment contract, and it's an insurance product, and it feels a lot like a bond. It's when you buy it, the insurance company is promising a certain rate of return each year, and so like a bond, there's that promised return, but the difference is that with a bond, you've lent money to a borrower, and there are rules about how the borrower must repay. With a GIC, it's a guaranteed insurance contract or guaranteed investment, and so you're dealing with the insurance company. It's an insurance company's promise. It's a little bit different, but functionally, it's very close to a bond.
Okay, someone asked, so is that like an annuity product?
The short answer is, I don't know. I don't know exactly what the rules are for a guaranteed investment contract as opposed to an annuity contract. They're both insurance contracts. The annuity is I believe more of a personal contract and a personal account that you can look at, and there can be in other investments inside the annuity and so forth. The guaranteed investment or the GIC is just, it's less personal. It's not you don't have an account with the insurance company the way you would with an annuity.
Okay. Someone else asks, is a target date fund good for my taxable account? And then what's an alternative simple way to use their RMDs?
Okay, so there are two questions.
Two questions I get, yeah.
Right. Let's talk about target date funds and your taxable account. It can be just fine for a taxable account. Again, it's if it's right for you, in the sense that the investment path is the one that you would choose for yourself, it can be fine. And if you could have a target date fund in your brokerage account or your personal account, after tax account, in your IRA and your 401k, you could do that. And that would be a perfectly fine approach. It's likely to be very well diversified. You can check on the expenses. Many of these target date funds are relatively inexpensive. And so that can be a very good way to go if you don't want to decide, you don't want to choose investments, and you're hiring, in effect, the portfolio manager for the fund to make your investment choices for you. And I will say you could do a lot worse than that. If you have and I don't mean to diminish it, I think it's quite a good option for many people, but I would encourage you to take a look inside, see what's there, and be sure that you're comfortable with the allocation, because they will tell you. It should be pretty easy to see how much stock and how much bonds there is in the target date fund, and for far out dates, a lot of them have a lot of stock, so you're going to see a lot of fluctuation. Mm-hmm. And so it's important to be sure that you're comfortable with that.
Okay, we get a question from Mark. Which is safer, a GIC or a treasury market money market fund?
Oh, they're both quite safe. If I had to choose, I would say that the treasury money market fund is going to be safer, but the GIC is going to be quite safe.
Okay. Mary wants to know, what would be an inexpensive cost for a target fund?
A target date fund, again, it's often possible to find one that's 10 basis points or less, 0.1% or less.
Okay. John wants to know, when should I use municipal bonds versus taxable bonds? And where should I use them, in either taxable or IRA type account?
Okay, so this is a this is a this is not a 101 question. This is a 201 or 301 question. But I will say, in general, over long periods of time, municipal bonds return less than taxable bonds for the same amount of risk, because they're tax advantaged. You don't pay tax in the your taxes are less, and so the people who buy them tend to be people in very high tax brackets who would see more of a disadvantage from having the taxable bonds. If you're in a 37% tax bracket, you're going to get more of an advantage from a municipal bond than if you're in a 20% tax bracket, because you're not paying tax on the interest for municipal bonds. That sort of gives you a clue about whether you should hold them in a tax deferred account. In general, the answer, or a tax advantaged account, in general, the answer is no, right? Because you're not paying taxes on the income in that account, right? And when you distribute from the IRA, the taxing authority doesn't ask what's in there, and doesn't give you a break if you've got municipal bonds in there, right? So you might as well have the higher returning bonds in the tax deferred account. In the taxable account, that's a question, I think, for another discussion: municipal bonds versus taxable bonds. So maybe someday we'll do a webinar on that.
Okay, Thomas wants to know, can you talk about asset allocation, or he says asset location, the likelihood that tax rates will go back up in a couple years? Is there a rule of thumb to try and get funds out of tax deferred funds into Roths while you're still working?
Okay, we're going to talk about Roths a little later, and he's asking about asset location, and I'm going to say this is fundamentals, and asset location is not a fundamental. And so again, that's something that we might address in a later webinar. It's a really good question, but I'd like to stay at the fundamental level here if we can. So I think now we can move on to the next section. So let's do that. And we're going to talk about managing your retirement accounts, and a couple of points here. We're going to talk about not leaving your employer accounts behind. We're going to talk about 401k and 403b rollovers, and we're going to talk about Roth conversions here. So the first point is, if you leave your employer retirement accounts with the 401k or 403b when you change jobs, that means that you're going to get one more statement each quarter. You've got one more account to allocate and reallocate whenever you rebalance, one more account to worry about, the possibility of forgetting about the account altogether, right? Occasionally you may see an email from your home state. I get one every once in a while that says, Massachusetts has found money that might belong to you. And you might say, well, where could that be from? And the answer is, it could be from an old 401k or 403b that you've forgotten about. And it's not impossible that you might just not, you might forget about these accounts. Life is busy and stuff happens. And 10 years from now, you might think to yourself, gee, I wonder, did I roll that old 401k over or not? And you don't want to have that worry, because then you have to check, and then you might forget, you might check and not be satisfied, then wait another 10 years, and then another 10 years, and time flies. You're not thinking about these old 401ks and 403bs. So the simplest thing to do is to do something with it, and I'm going to talk about what you can do in just a minute. Nothing happens to your IRA when you change jobs, so there's nothing to worry about. But when you leave an employer, and where you have a 401k or 403b, that account is going to stay there unless you do something with it. And I've got an asterisk here. If your account balance is small, your employer might close the plan and send you the money. So that solves that problem. But I'm talking about situations where the plan isn't small and they don't send you a check. Okay, so the first thing you could do is to roll it into your new employer's plan. And you can, if they have one, that works. This is a good idea if the plan has good investment options. You can continue to be broadly diversified, and if the options align with your investment strategy. And if the plan will accept your rollover, most will, but occasionally they may say you can't do it. This is not so great to do if the investment options are poor. And by poor, I mean expensive, not well diversified, not aligned with your investment strategy. You could roll it into a rollover IRA. This is probably going to give you the most investment flexibility. It's a great thing to do because you can do it. Often you'll have lower expenses than you had with the old plan, and you may have better choices. And if you keep it in a rollover IRA, often you can roll it back into your next employer's plan, right? You went from employer A to employer B. Who knows how long you'll be with employer B? Maybe you're going to go to employer C, and you might decide that employer C's plan is better than B's, less expensive, better choices, and then you might move the money from the rollover IRA back into the new employer C's plan. Now, there's one drawback to this, which is that if you want to do what are called backdoor Roth contributions, that can get complicated if you have assets in your IRA. So we'll talk about that in just a minute. Now, what about Roth conversions? And we had a question about Roth conversions earlier. So let's talk about, first of all, what a Roth conversion is. Roth conversion is to move assets from a regular IRA to a Roth IRA. And a regular IRA, usually the assets are pre-tax assets. And with a Roth IRA, the assets are after-tax assets. And distributions from a Roth are tax-free. So that could be advantageous. Now, when you do this conversion, that conversion is a taxable event. The moving the money out of the IRA counts as a taxable event, and if the money in there is pre-tax money, you'll owe ordinary income tax on the money that you convert into the Roth IRA. So I'm going to look at we'll show how that works in these tables in just a minute. Importantly, however, you can do this conversion and have the taxable event before 59.5, and there's no penalty. So that's an advantage. And we're going to talk in a minute about taking money out of an IRA or a 401k or 403b before 59.5, and if you take a distribution and keep the money doesn't go into a Roth IRA or into another IRA, then you pay tax on the distribution and there's a 10% penalty. There's no penalty with Roth conversions. So why would you do that? Well, you're converting a tax-deferred account to tax-free account. That's can be good. You're increasing the after-tax content of your tax-free accounts. You may be reducing your lifetime taxes, and you may increase your lifetime after-tax assets. But those benefits accrue only if, I will say only if, you're doing it in a year when you're in a lower tax bracket than usual. And it can be really disadvantageous if you do it in a year when you're in a higher tax bracket than usual. And one additional consideration is if you are on Medicare or close to being on Medicare, within 2 years of being on Medicare, you have to consider IRMAA which is a Medicare surcharge that accrues to people that have higher incomes, you have to consider that IRMA as part of the taxes. So you can't just look at the your tax return and sort of simulate your future taxes. You also have to recognize that there could be IRMA as an additional tax. Okay, so how can that be advantageous? Let's look at the table here. So suppose that we're converting $100,000 and we have a choice of doing it in a year when our tax rate is 37% or a year when our tax rate is 12%. If we do it in the year when our tax rate is 37%, we owe $37,000 in taxes. And we have in the Roth 63,000. On the other hand, if we do it in a year when we're in the 12% bracket, we pay 12,000 in taxes. We get 88,000 in the Roth. That's much better, right? Lower rate, less taxes, more in the Roth account. So there's your general rule. Look for a year when your tax rate's low. That's likely to be a good year for Roth conversions. Now, there can be a question about what should you where should you pay the taxes from? So if you pay the taxes from your taxable account, if you this is not as clear as I'd like it to be, but if we're in the 12% year, right, and we've got 100,000 in the IRA and 100,000 in the taxable account, and we convert 100,000. So then after the conversion, we've got 100,000 in the Roth, 88,000 in the taxable account, because we paid the 12,000 out of the taxable account. Or we could pay the 12,000 from the IRA. And if we do that, then we're going to have 88,000 in the Roth and 100,000 in the taxable. And we'd rather have this situation than this situation. We have more money that's in the tax-free account and less money in the taxable account. And that's advantageous. Okay, so now suppose that we want to take money out of our retirement plan before we retire. There are penalties to think about. We could think about maybe instead of taking it out for good and all, we could borrow from the 401k or 403b. We can think about reasons that we can take the money out without paying penalties. And we can think about another method that's called the 72T that allows you to take money out penalty-free, even if you don't have a particularly good reason as far as the IRS is concerned. Okay, so Congress and the law strongly discourage you from taking money out before 59 and a half. Congress made the law to make it difficult, they made it taxable, and they imposed this 10% tax penalty. So in general, preferable not to take the money out of an IRA or 401k or 403b before you turn 59 and a half. Now, if you need money, you can borrow it often from your employer plan if the employer plan allows you to borrow. And there's an opportunity cost, but the opportunity cost is that your money is not invested. And so just as with any account you might withdraw in assets from, you're losing the investment earnings. When you put the money back, you are charged interest, and I'm putting the interest in quotes because it's money that comes from your taxable account and goes into the tax deferred account. So it's your money in both cases. You're not paying an outside party that interest. So it's not a cost to you. And you can think of it as an extra contribution. So that this can be a really helpful way to access money from a retirement account if you need it for a short-term purpose. And it's effectively the same as taking money from any savings account and then replacing it. Be careful if you're planning to change jobs before the loan is due back and you're planning to repay it, because if you change jobs, the loan becomes due immediately. And if you don't repay it, then the unpaid loan is taxable income, and you're going to owe the penalty. So a little bit of caution required here. Now, if you want to take money out of a 401k, 403b, and I'm saying take it out now as opposed to borrow it, from a 401k, 403b, or an IRA, there are reasons that you can do that without penalty, and possible reasons you see here, right? To do something with your house, buy it, improve it, medical expenses, education expenses. Whether you're eligible to do that without penalty or not depends on, as we show here, the plan type, how long you're going to, the holding period for the assets, how long they've been there, and your age. So you want to consult a professional when you do this before you do it, so you're sure you don't run afoul of the rules and end up paying a penalty. That it's I wish it were different, but it's not. That there's risk associated with this if you don't follow the rules. Now, there's also something called 72T, Rule 72T of the Internal Revenue Code, that allows early withdrawals without penalty. This is one more way to access your retirement account assets. And I say, don't try this at home. Don't try this without professional advice, because the rules are complicated, calculations are complicated, and it's expensive if you do it wrong, because you're going to pay tax penalties, and that would be very unpleasant. So if you really need the money, and the retirement plan is the only place to get it, you can go there and you can get money out without penalty, but the rules are very tight, and so you want to be sure to get help so that you can follow them. All right, now, what about after you retire, taking money out? What sequence should you use from various accounts, and how do you maximize your after-tax income? Okay, so the first point here is that Congress wants you to use your retirement assets while you're retired. So they've set up something called required minimum distributions, and they apply both to IRAs and employer plans. And once you reach age 73, and there are little caveats to this because it varies on this age will change again for people that are born after 1959. But right now the rule is once you reach 73, you've got to start to withdraw from your plan assets, and you've got to draw them down over your lifetime. And the IRS has tables for you to follow. If you continue to work, you can continue to contribute. Roth IRAs and Roth plans in general are different. There's no required minimum distribution from Roth assets for the original owner of the plan. But when you're thinking about the required minimum distributions, it's important to draw at least as much as is required, because there are penalties if you draw too little, and those penalties can be significant. But future you is now getting their present after you retire and after you start required minimum distributions. Now, should you just follow the rules for required minimum distributions? Do you have to do that? And is that enough? You may see rules of thumb like draw your taxable assets first before you draw anything from an IRA if you can help it, then draw down your IRA, then draw down your 401k or 403b, and then draw the Roth at the end. And that sort of conventional wisdom may be right, but it's going to be right only by accident. The best way to withdraw is to smooth your marginal tax rate. That is, you want to draw so that each year your marginal tax rate is the same. And one way to think about or understand that is, let's look at a chart here. So suppose that your income in retirement is going to look like this, or as you get close to retirement, you're going to retire at the end of your 61st year, and you're going to be retired from 62 on. And Social Security, you're going to start at 69, and then your required minimum distributions I'm showing here starting at 72. You could make it 73, but look at what's what's going to happen to our tax bracket here? We've got much more income at 61 and 60 and 61 than we do at 62. And then we have a little bit more income at 69, 70, and 71. And then when our required minimum distributions start, we're going to have a lot of income. So these are going to be high tax bracket years. These are going to be really low tax bracket years. So if we can move income from here to here, we're going to reduce our taxes. We're going to get higher after-tax income. So the fundamental principle is we'd like to smooth that out. And when you see a graph like this, if you plot it out for yourself, this you should look at that and say, this could be a tax saving opportunity. And so we want to draw from the, in this case, we might want to draw like this, right? We might want to make some draws from the retirement accounts earlier so that our income is the same every year. And then our tax rate's going to be the same every year. And that's going to give us the best outcome. So that's the fundamental idea here. So rules of thumb are, it may be the case that your situation is different and your income is going to be the same every year, kind of no matter what you do, right? If you work until you start Social Security and your required minimum distributions are of a certain size, then it could be that you get a graph that looks like this by doing nothing, and that's fine. But if your situation looks more like this, then you may want to take a more active approach. Okay, Carrie, we've got time for a couple of questions.
Okay. So let's see. Okay, would you still roll an employer plan into an IRA if the employer plan has a GIC with a hedge on risk by a guaranteed return, albeit a small 3% return?
I see. That's kind of a close call. I think that it's going to depend on the GIC and how much longer it's got to go and what the return is and what return you think you can get on a similar low risk investment, because there are lots of low risk investments. So I think that's pretty much a personal decision. I would want to look at the GIC, I guess, and look at what the alternatives are. But the IRA is going to have lots of low risk options, in the long run, I suspect it's not going to make a whole great deal of difference. That the insurance company has the underlying investments that the insurance company has access to are the same as the investments that you're going to have access to in your IRA. There's no special sauce that they have at the insurance company that allows them to offer some special risk-free rate that isn't accessible anywhere except through them. They're great people, I'm sure, but they can't do magic.
Okay, can I convert an inherited IRA distribution to a Roth account?
No.
Well, that was simple.
No, it's a distribution. So you cannot, in general, convert required minimum distributions at all. So you can't do a Roth conversion with a required minimum distribution. It's coming out of the IRA and it's income, but you don't get the opportunity to put it in the Roth. You could the year before. Suppose that you're 72 and your RMDs start next year. You could do a Roth conversion this year. Next year, you have to take the required minimum distribution. And then after you've done that, then you could do another Roth conversion. But you have to take the required minimum distribution and pay taxes on it. And you can't put any of that in the Roth.
Okay.
And it's no different if it's an inherited Roth or a beneficiary, or sorry,
Oh,
an
okay.
inherited IRA or beneficiary IRA.
Okay, we have another question. The RMDs is it, is that something you would automate?
Often, if you have if you're working with many brokerage firms will automate the RMD. So you can go to a representative at the broker dealer or the mutual fund company and say, can I automate my RMD? And the answer is often yes. Often they will send you a payment each month, or once a quarter, or once a year. They're going to be pretty flexible to provide you with payouts that are convenient for you.
Okay. Here's another. Is it possible to continue to contribute to a Roth in retirement? For example, from a 1099 job with actual income?
Yes. Yes, you can contribute to a retirement account. Whether you can contribute to the Roth is a function of your income as well as it. So if you have earned income, you can continue to contribute to an IRA or a Roth, but the contribution rules still apply.
Oh, okay.
That the IRS does. I mean, the IRS doesn't think you're retired if you've got earned income. They don't look and see, oh, Joe used to work at Multi-Widget, and he retired from Multi-Widget, so he's retired, and the fact that he's getting this 1099 income is sort of extra. No, the IRS says, yeah, you've got income, you can contribute. You've got earned income, you can contribute. You can't contribute from investment income, that sort of thing.
Okay.
I think this should be the last question.
Yeah, I think that covers it for folks.
Okay, good. All right. So then, wrapping up here, from this section of the series, choose your asset allocation carefully and stick to it. Update your allocation every 5 years or so. So it's not, you don't update it every year because this year you feel really good. You think you've got, the market's up, and so you feel like you can afford more risk, and next year you adjust the allocation down because the market's bad and you feel like you can afford less risk. Do it on a slower schedule and do your best to take emotion out of it. Diversify. Broad mutual funds rather than individual stocks or narrow mutual funds. Keep the portfolio simple so that you understand it and so that it's easy to track. Keep your costs down. More cost, less present. Avoid the temptation to try to predict where the markets are going. No one can. And even though I'm sure you're very informed and very knowledgeable, no one has demonstrated, I shouldn't say no one, the number of people who've demonstrated their ability to successfully predict, predict where the market's going and invest accordingly, their names, because it's really hard to do. If it was easy to do, it wouldn't be special, and you wouldn't know the names of any really successful investors. If you've got to draw from your retirement account early, get advice. It's easy to make a mistake and have it be expensive. And then when you're taking distributions, strive for smooth income and a smooth marginal tax rate. Okay, so upcoming webinars, we hope you'll join us for the Basics of Estate Planning Part 2. That's next month, August 29th at 2. Then in September, we're going to talk about tips for beginners. We had a webinar on tips a year or so ago, and it was very popular, but it was also very complicated. So we're going to offer a more simplified version. That's at the end of September on the 28th at 2. Thank you for joining us. You can find more about us at our website, and we're on Facebook and LinkedIn, and we've got offices in Boston and San Diego. Have a great day.